There's a pattern in history that has destroyed every single global reserve currency. The Portuguese real collapsed after 80 years of dominance. The Dutch guilder fell after 80 years, and the British pound died after 105 years. Each one followed the same 7 stages. Each one thought it was different, and each one was dead wrong. The dollar became the world's reserve currency in 1944. That was 81 years ago. Today, in 2025, the dollar is in stage 5 of that same 7-stage pattern. This isn't prophecy, it's mathematical certainty. What is a reserve currency? A reserve currency is the currency that other countries' central banks hold in reserve, used to price global commodities and denominate international trade in. When you're the reserve currency, every country needs your currency to buy oil, settle trades, and hold safe assets. This creates what's called exorbitant privilege. You can print money to buy real goods while other countries have to produce goods to earn your currency. You can run persistent trade deficits and borrow at lower interest rates. Being the reserve currency is the ultimate economic weapon. Stage 1. Military dominance and trade route control. Every reserve currency starts with overwhelming military force controlling key trade routes. In the 1450s, Portugal mastered ocean navigation, opening up Asian routes around the Cape of Good Hope. Their warships controlled the Indian Ocean, the South China Sea, and the Atlantic, establishing armed fortresses at strategic choke points. The real became international currency because cannons backed it up. In the 1600s, the Dutch East India Company had 40 warships and 20,000 soldiers, controlling the Spice Islands and making Amsterdam the global trade hub. In the 1800s, the British Royal Navy had more warships than the next 5 nations combined, controlling every critical trade choke point: Suez, Gibraltar, Singapore, you name it. After World War II, the U.S. had 11 carrier battle groups controlling every key trade point: Hormuz, Malacca, Suez, Panama. The dollar achieved this in 1945 and has maintained it ever since. Stage 2. Massive trade surpluses. Once you control the trade routes, you accumulate wealth through favorable exchanges. In the 1500s, Portugal bought spices cheap in Asia and sold European goods at 10 times the price. The trade surplus made Lisbon one of Europe's wealthiest cities. In the 1600s, Amsterdam became the world's warehouse. The Dutch bought low in one market and sold high in another. They were global-scale arbitrageurs. Trade surpluses were massive, and mansions lined the canals. In the 1800s, Britain ran the largest trade surplus in history, exporting manufactured goods to the world. London's financial district handled more capital than the rest of Europe combined. From 1945 to 1970, America ran the most dramatic trade surplus ever. After World War II, the U.S. was the only industrial power with its infrastructure intact, exporting machinery, cars, and steel to the world. By the 1950s, the gold reserves at Fort Knox exceeded 20,000 tons, more than the rest of the world combined. But Stage 2 doesn't last forever. Reserve currency nations shift from production to consumption, from surplus to deficit. Stage 3. Reserve currency status gets formalized. The world officially adopts your currency as the reserve. This is the peak of power. Portugal in the early 1500s, the Netherlands in the mid-1600s, Britain after the Congress of Vienna in 1815, America at Bretton Woods in 1944, when 44 nations formally agreed the dollar would be the world's reserve currency. But Stage 3 is the peak, and it's all downhill from there. That's because formalization plants the seeds of self-destruction. Once you become the reserve currency, the world needs more of your currency than it needs your goods, so you stop producing and start importing. This is the Triffin Dilemma. To give the world enough dollars, America has to run persistent trade deficits. But persistent deficits undermine the currency's value. You can't be the reserve currency and maintain a strong trade balance. It's mathematically impossible. Stage 4. Deficit spending and living beyond your means. The reserve currency nation stops creating wealth and starts consuming it. By the mid-1500s, Portugal's trade surplus vanished. They started importing everything, paying for it with Brazilian gold. The king spent lavishly. As long as the gold kept coming, he could keep spending. But they weren't building anything productive, just consuming. In the 1700s, the Netherlands became a net importer. Investment shifted from trade to finance. They became Europe's bankers. This generated passive income, not productive growth. By the early 1900s, Britain ran persistent trade deficits, paying for them with returns on overseas investments. But that's extracting wealth created elsewhere. British manufacturing declined, and factories that once led the Industrial Revolution fell behind American and German competitors. America entered stage 4 in 1971 when the trade surplus permanently reversed. By the 2000s, the U.S. ran the largest trade deficit in history, $800 billion a year. America imports far more than it exports, trading printed money for physical goods. This only works because the dollar is the reserve currency. Stage 5. Currency devaluation and money printing. When the deficits become unsustainable, you devalue the currency and print money. In the 1550s, Portugal started debasing the real, reducing the silver content in coins. By the 1570s, it lost credibility, and merchants started preferring other currencies. In the 1700s, the Dutch government borrowed heavily to fund wars and colonial empire, printing money to cover deficits. The guilder's value dropped, and by the 1780s, it was no longer the preferred currency for international trade. Britain devalued the pound through 2 world wars, repeatedly devaluing in 1949 and 1967. By the 1970s, the pound was just a regional currency. America entered stage 5 in 2008. The financial crisis forced the Fed into quantitative easing, creating $3.5 trillion from 2008 to 2014. During COVID, from 2020 to 2022, they printed another $7 trillion. Money supply expansion at rates exceeding anything in American history except wartime. Inflation in 2021 and 2022 hit levels not seen in 40 years. The dollar is global, so when the Fed prints money, it exports inflation to the entire world. This stage is where confidence starts to crack. Stage 6. Loss of confidence and search for alternatives. The world starts looking for a way out. Trust in the reserve currency erodes. In the 1570s and 1580s, confidence in Portugal collapsed. Merchants started demanding payment in other currencies. After World War II, confidence in the pound evaporated quickly. The 1949 devaluation of 30% meant international holders lost nearly a third of their value overnight. By 1960, the pound's share of global reserves dropped from 60% to under 20%. The transition was complete in 15 years. The dollar is now in the early stages of stage 6. China and Russia started reducing dollar reserves in the 2010s, buying thousands of tons of gold. Russia liquidated almost all U.S. treasuries after 2014. BRICS nations announced plans in 2023 to launch a BRICS currency. Saudi Arabia started accepting yuan for oil purchases in 2023, breaking a 50-year practice. The dollar's share of global reserves dropped from 72% in 2000 to 58% in 2024. Smaller nations are negotiating trade settlements in local currencies. This is the beginning of stage 6. The world is seeing the same pattern that destroyed every previous reserve currency. Endless deficits, currency devaluation, loss of purchasing power. Stage 7. Replacement and collapse. A new currency rises to replace the old one, not through formal agreement, but through market adoption. The Portuguese real was replaced by the Spanish silver peso in the late 1500s. The transition happened over 20 years. The Dutch guilder was replaced by the pound in the late 1700s, taking about 30 years. The pound was replaced by the dollar from 1945 to 1960. What will replace the dollar? The answer isn't clear yet. China has the surplus and production, but doesn't control trade routes, and the yuan isn't freely convertible. The euro has deep structural problems. Gold can't scale to handle trillions in daily transactions. The most likely scenario is a chaotic transition, a multipolar period where several currencies compete. Several regional currencies for different trade zones. It's going to be turbulent and economically painful. What this means for you. When a reserve currency collapses, it destroys ordinary people's savings and wealth. Since 2020, the dollar has lost about 25% of its value through inflation. If the pattern holds, the next decade will see accelerated decline. When stage 7 arrives, the dollar could lose 50% of its value in a matter of months. What should you do? Understand that holding dollars is a risk. Diversify away from pure dollar exposure. Hold assets that preserve value across currencies. Real estate, productive businesses, commodities. Watch central bank reserve data, trade agreements, gold prices. Understand this isn't about politics, it's about math. Every reserve currency follows the same 7 stages. The dollar is in stage 5, entering stage 6. The timeline. The Portuguese real lasted 80 years, 1450 to 1530. The Dutch guilder 80 years, 1640 to 1720. The British 105 pound years, 1815 to 1920. The dollar gained reserve status in 1944. That's 81 years ago, right at the average lifespan, showing every symptom of late-stage decline. But this time really is different. Every previous reserve currency collapse was regional, but a dollar collapse is global. The dollar is embedded in every economy, with over $70 trillion in dollar-denominated bonds worldwide. This isn't just a currency switch. It's a reorganization of the entire global financial system. The pattern is clear. The timeline is obvious. The dollar is in stage 5. History says stages 6 and 7 follow, not as a possibility, but as near certainty. This is how reserve currencies die, not through invasion or disaster, but through mathematics. Slowly at first, then fast. Ignored first, then undeniable. People who understand this position themselves accordingly, holding assets that preserve value across currencies. By the time everyone sees it, the transition is already complete.